Presenting here the clear summary of Enron's modus operandi for financial window dressing and fraud. 1. Mark-to-market accounting abuse. Enron recorded projected future profits as current revenue. Even if a project would take years to generate cash, they booked its entire expected profit immediately, inflating current earnings. 2. Special purpose entities, SPEs. Enron created off-balance sheet companies to hide debt and losses. These SPEs were used to sell underperforming assets or hedge risks, making Enron's financial statements look healthier than reality. 3. Complex derivatives and contracts. Enron used complex financial instruments and energy contracts to manipulate reported income. These deals were intentionally opaque, so auditors, investors, and regulators couldn't easily detect risk or losses. 4. Stock price manipulation. The company pressured analysts and employees to maintain a high stock price. Stock-based compensation encouraged executives to prioritize short-term stock gains over long-term health. 5. Fraudulent financial reporting. Enron misrepresented liabilities and profits in financial statements. They often concealed true financial performance, overstating earnings and underreporting debt. 6. Cultural enablers. Aggressive management culture focused on meeting quarterly expectations at any cost. Auditors and internal controls failed due to conflicts of interest and intimidation. In essence, Enron's scheme relied on inflating profits, hiding debts, and using complex off-balance sheet entities to create an illusion of financial success, all while cash flows and real value were deteriorating. In the late 1990s, Enron was the golden child of corporate America. A simple gas pipeline company turned into a global energy trading empire worth over $70 billion. Fortune magazine called it America's most innovative company. But behind that glowing glass tower, something dark was brewing. Enron called a meeting of top management to plan the show. Kenneth Lay, founder, calm, visionary. Jeffrey Skilling, CEO, aggressive, ambitious. Andrew Fastow, CFO, cunning, technical mastermind, were all present in the meeting.
Gentlemen, Enron isn't just selling energy anymore. We're selling the future. We'll trade electricity, broadband, even weather. We'll make money before we even deliver a single unit.
And we'll keep Wall Street dazzled with profits, real or not.
The trio revolutionized Enron and redefined accounting itself. But they didn't build a company. They built a mirage. Enron leaders changed accounting rules to record future, hypothetical income immediately, which was a fundamental shift away from traditional practices. The consequence was creating a false financial appearance, a mirage of explosive growth that wasn't supported by actual cash or business operations, ultimately leading to collapse. Enron adopted mark-to-market accounting, a method that allowed it to record projected future profits as current income, even before the company actually earned any cash. This made Enron's financial statements look far more profitable than they really were, creating an illusion of continuous growth and success.
Sir, this deal is for the next 10 years. Should we really record all the profit now?
This statement highlights the accountant's ethical concern regarding mark-to-market accounting, where Enron was immediately recording the entire estimated profit from a long-term, 10-year contract, despite the cash not being received yet. It shows a clear internal doubt about booking future, non-guaranteed money as present-day revenue.
The market believes in Enron, so the numbers should too.
This philosophy allowed Enron to justify wildly optimistic, subjective valuations, leading to the creation of fictitious profits that had no basis in actual cash flow. The reliance on market belief instead of verifiable transactions resulted in a massive disconnect between reported income and the company's financial reality. This highlights the core failure of Enron. They focused on inflating paper profits through accounting tricks like mark-to-market, which rapidly increased their reported income but produced no actual cash flow to sustain a business. The side effect was that Enron's leaders had to resort to fraudulently hiding billions in debt in off-balance sheet entities to cover the widening gap between their spectacular earnings reports and their actual, failing financial health. The preceding presentation is a dramatized interpretation of the Enron modus operandi, designed solely for educational study to facilitate understanding of the core concepts. Viewers should be aware that the scenes and dialogue are not an actual reflection of historical events. Our next segment will explore how Enron manipulated financials using complex contracts and derivatives, a practice known as window dressing. Please ensure you are subscribed to receive immediate notification upon its release.